In this video, we continue to look into the foreign exchange or Forex market and explain in simple terms some more of the mechanics behind Forex trading. A currency pair is made up of the base currency and of the quote or counter currency. In the example of Euro-USD, the euro is the base currency and the US dollar is the counter currency. Each Forex pair will be quoted with a bid price and an ask price. The bid is the price that a currency pair can be sold, and the ask is the price that a pair can be bought. The difference between the bid and the ask price is known as the spread. The spread varies from Forex pair to Forex pair. The general rule of thumb is that the more popular and highly liquid a pair is, the smaller the spread. The less popular Forex pairs, such as the exotic US dollar Swedish krona, will have a much wider spread. The spread is measured in pips, which is the basic price increment of a currency pair. For example, if the bid price for Euro-USD is 1.1064 and the ask price is 1.1066, then the spread is measured as 2 pips. Traders often refer to their profit or loss on a Forex trade by the pip value. Most currency pairs are quoted to 4 decimal points. That is, 1 pip is equal to 0.0001. The Japanese yen, however, breaks the 4 decimal point rule and only uses 2 decimal points. That is, 1 pip is equal to 0.01. ADSS offer fractional pips on all Forex products. That is, there is a 5th decimal place for most pairs, with yen pairs quoted to 3 decimals. The fractional pip, also known as a pipette, is 1/10 of a pip. The pipette has been introduced for several reasons. First, it allows for better trade execution with less slippage. Second, spreads can be quoted more tightly, which means traders are getting a fairer reflection of underlying liquidity and volatility. And finally, it allows traders to choose more accurate stop and take profit levels. Leverage is the ability to control a large amount of money with a small deposit. It is essentially the multiplier of a trading deposit. In Forex, it allows a trader to trade larger financial positions with relatively smaller trading accounts. For example, if we look at a $100,000 position and a leverage ratio of 10:1, you will need $10,000 from your trading account to control $100,000. The $10,000 from your trading account is referred to as the margin required by your broker, which is treated as a deposit. If the position rises by $1,000 to $101,000, and as your return is 10:1, you would have gained $1,000 plus have the $10,000 margin returned to your account. It is important to understand that margin trading is a two-way street, and had the investment devalued by $1,000, you would have lost $1,000 of your $10,000 margin. A margin call is what happens when your trading account falls below the margin requirements. A trader would be required to deposit extra funds to cover the shortfall, or the position could be closed out. Forex in general has the highest degree of leverage of all the financial markets and allows traders to enter the markets with a much smaller trading account than is traditionally the case with stocks and commodities. It is therefore essential to implement a thorough risk management plan in your Forex trading.